Hello, all. We might have all heard about ETFs, mutual funds, passive investing, a lot of financial jargons like that. And I'm sure it's really overwhelming for any investor or any common man to really understand these jargons and what this means. In today's session, I'm going to explain about what an ETF is, what is passive investing, and also the epitome of ETF and index investing concept, which is Vanguard. And Vanguard Investments was founded by John C. Bogle. John Bogle is considered as the father of index investing. He recently died, unfortunate incident. He has contributed a lot towards the field of investing, and Vanguard is, the largest ETFs that we all know that exist today, one of the largest in the top three. And I'm sure I'm going to explain to you or break it down all these concepts, what an ETF, what is passive investing at the end of this video. If you find them interesting, subscribe and also leave some comments if you have any questions at the end of this video. I'll take a look and explain back on one-on-one on the comments. Now let's get into the details and understand what each of these means. So I'm not going to bore you, I promise, with another presentation and slideware, but here's a simple snippet I have put just to understand the key terms. An ETF means exchange traded funds. It's a collection of securities that track an underlying index. It could have a combination of stocks, bonds, different types of assets, commodities, etc. Some of the ETFs can be even theme based, like they will invest in only technology stocks, only cloud based stocks, only industrial stocks. So it could be even based on some thematic sector based funds. Now, as the name says, an exchange traded fund or ETF is traded on the exchange, and there is a real time pricing for an ETF, just like stocks. Now, there will be, the key difference between a mutual fund and an ETF is that mutual funds are not traded in out throughout the day, whereas it is just traded once a day after the market closure. Now, we have to understand this phenomenal factor that 80% of market transactions today traded are based on ETF or through ETFs. And especially millennial investors are flocking into the ETFs for the ease of investing, because there is no pain of understanding the stocks and picking stocks and churning the funds, picking the fund manager, etc., etc. So it's so easy, and there are so many applications, so many tools and available in the market, so many products available in the market, and like Robinhood and many other, through which you can just invest in on a click of a button. So especially with mobile, it's even more easier. Now, example of ETFs are Spider S&P 500 ETF, the ticker symbol is SPY, that tracks a US-based S&P index. That is an index, US index, which is stock-based ETF. There are different types of ETFs, as I said, based on countries, themes, currencies, commodities, etc. Now, why ETF and what are the advantages of ETFs? Now, the main advantage is that it's low fees and or almost no fees when compared to the mutual funds expense ratio. Understand now what is expense ratio? Don't have to break your head. It's just a administrative fees for managing the funds. Mutual funds charge a higher expense ratio, whereas ETFs are exchange traded funds, and ETFs or index funds have even lower fees in terms of expense ratio, because administrative part is less, churn is less. So it's very small fees, nominal fee that you're paying. Once I take you to the Vanguard page, you can see what are the expense ratios for different funds. It could be in the range of 0.04 percentage, 0.4 percentage, sometimes 0.6 percentage. So it varies, and ETFs are Vanguard ETFs, for example, have very low rates like 0.05 up to 0.5 percentage. So based on different types of funds. Now, that's a main advantage of having ETF. That's low fees of management fees or administration fees that you're paying. Tax efficient due to the low churn in the holdings. Once you each time you don't keep buying and selling funds, where in a typical mutual funds, when the fund manager sells equities or bonds or whatever, there are, whenever the capital gains are fetched, there will be a capital gains that needs to be paid as part of the tax. So here there is not much churn, so it's very low churn funds, and it's tax efficient. Diversification can still be achieved by choosing different types of ETFs. Not that you have to load your portfolio with 15 ETFs, but you could have just 3 to 4 different types of ETF across different markets, like developed markets, emerging markets, industries, and there are different themes that are appearing. If you want to play like a new emerging theme, you don't know what stocks to play, like biotechnology, you could buy a basket of stocks like that, under the ETF. So the ETF will have an underlying set of stocks representing some kind of themes. Now, the other advantage is self-managed investing, then depend on fund manager's performance. You don't need to understand what the fund, how great the fund manager is to before investing like in a mutual fund. Here it is self-managed, so that's great. And dollar cost averaging is possible by consistently investing in ETFs through autopilot option. You can autopilot it month on month salaries. You just goes to the ETF and it just dollar cost average. For example, the markets are crashed now. Once if you invest in these next to this month or next 2 to 3 months or even up to 6 months, you might be getting entering at a very lower value at a price than earlier in the 6 months back, right? So you get the advantages of when the market gyrations happen, it goes on up, and you get the advantages of the cost. Now, the only limitation I would say is that ETFs is low returns because of the low risk factor, and it can be that indexes sometimes can really underperform for long periods of time. Example, now where you don't know when the market crash of 2020 will revert back, when will it we will get back up to the old levels. So index can really underperform for a long time, but still for a common man, common stock picker, somebody who cannot pick a stock, common people cannot really understand the dynamics of markets and understand the business dynamics, cannot pick stocks or pick funds for that matter. ETFs is the best alternative because at least investing for 8 to 9% index returns is still great. Now let's get into the Vanguard's ETFs. I'm in that page, so you can just visit investor.vanguard.com, and there is all lot of a whole set of details put there. If you can learn more in depth what an ETF is, what you can compare what ETFs are against the mutual funds, what are the advantages. You can choose your Vanguard ETF. A lot of options are there, and a lot of other materials are there here. You can see what kind of funds are there, what is bond. It's a treasure of wealth that you can see and understand. Now, Vanguard ETFs, primarily you can see that here there are 74 matching ETFs, and these exchange traded funds combine, bonds, stocks. So the US bonds is the safest, as we all know. Globally, that's the US bond ETFs. It's like a treasury bond. Then you have, there are different types like long-term treasury bond, which is like, you can see the returns here since inception, since last 10, 11 years. It's returned pretty good, 8.28% for a bond, and long-term US bonds has done really well in the last 10 years, 11 years. Similarly, you can look at other type of bonds, corporate bonds, which might be having higher returns, but now it might be a riskier period. So there is another point you need to understand, that when the markets, when the interest rates are really low, like at the current levels of 0 or 0.25, it's not a good idea to go for really long-term bonds like 30-year, because you'll get locked up there, and the returns might be very undergraded, because it is only up way the interest rates are going to go from here on. After 2 years, 3 years, when the economy picks up, interest rates might go up. At that point of time, you will lose out if you pick a 30-year bond now, because you don't want to enter at a 0.1% less than at a nominal rate of bond return. So it's a good idea to pick intermediary or short-term bonds, like 1 or 2 years bonds, which could give you the advantage, because when the markets or the interest rates goes back up after say 1 year, 2 years, and your bond matures, you can gain the benefit of moving into a higher interest bond. So those are the some of the integrities you will understand when you get more into details of the bond market. But at this point, I'm going to explain only about the ETF. Now, how much should somebody have in bonds against stock ETF? I would say it's up to the person's risk appetite and also age and many other factors. Suppose if somebody is near the retirement age, it is not advisable to go for 100% ETF. Stocks or individual stock picking. It is better to go for a combination. It all depends. You can consult your financial advisors. Now, I would recommend, if I'm somebody, I would look at having at least 15 to 15% of my portfolio in bonds, better than having cash, because when the market crashes, you are being in bonds. It is good idea, to get some returns. And when you have really short-term bonds, you can really churn out, and when the market crash happens, you can utilize that period to put them up. It's okay to break and enter the bonds, and enter the stocks. I do have some cash, some bonds, and but a 90-95% of my portfolio usually remains in stocks because I like to pick stocks. Now, somebody can also look at having, say, 70-80 percentage of their portfolio in US stock ETFs, because there are a lot of stock ETFs. It's not only US stock ETFs. You can also look at international. Now, you in US you have S&P 500 ETF, which is the most famous, most common. Look at the returns; it's pretty good, 9.69 percentage. And there is another one, S&P Growth 500. So there are also risk levels. If you look at each of these ETF, what is the risk level? So there could be between range of 1 to 5. You can see that in the page here. You can also see the performance once you get into the details. Once you click how, so here the risk level is higher for this S&P. Obviously, it's a stock-based fund. The ticker symbol is VOO, and you can see the price and performance, and how it has performed over the period of years, and all of that. And it what is a bid size and ask size. So it's an exchange traded fund, so obviously you will have the real time pricing. What is a 52-week high, 52-week low? Look at this. So 2020, look at the market gyrations here just on an ETF, stock based ETF. So on 52-week high was hit on Feb 19 2020, and it is the peak, the low is pretty much in just a month's time it hit the low. Look at this fall, it is 51%. So that is a risk level 4. Even though it is an ETF, the risk level is high. So you can imagine how much risk levels are for picking individual stocks. Some stocks have fallen up to 50, 60, 70, 80%. So it's really a high risk investment if you see on the stock ETF. But if you look at bond ETF, it would be much low risk, because you would have returns are also balancing that kind of a risk level. So you can see that. Now, coming back to this page, you can see all the short-term bonds performance, short-term bonds and long-term bonds performance, and different types of ETFs. You can also have other countries ETF, for example, different market sizes, mid cap, small cap. So Russell 2000 is a small cap ETF. You will have all the small stocks. Small cap, when I say, it is less than, say, $10 billion market capitalization. Based on the market capitalization, there is no fixed, it's not cast in stone, just that it is there is a hard demarcation, but just a rough understanding of what the levels of market capitalization, that's a capitalization it means. And so you have S&P mid cap fund, S&P Russell 2000. These will be even more riskier because these are smaller companies as against a large ETF, S&P 500 ETF, because here small cap will be subject to even more fluctuations and risk levels when the market goes down, economy goes down, right? So that's the reason. Then you have the international bond funds, emerging market funds. The emerging market is a good way to diversify and get some growth. Although they have underperformed in the last 7 years, you can see the returns have been mediocre. And so that's pretty much. So you will have a FTSE emerging markets, different type of specialty funds, like sector based, consumer staples based, healthcare based, information technology based. So different types of sectors also can be another criteria to select funds. So I would say, like, distributing between 3 to 4 types of funds would diversify and give a good diversification, and at the same time you can get benefits of different upturns in the markets when the economy picks up. It's a good time to enter S&P 500 ETF. It's down 50%. A year or 2 year from now, it could be a easy doubler, I would say, at this point of time when you look back. But anyway, please consult with your financial advisors before choosing your portfolios and doing things. So I hope this was helpful. I just wanted to clear the ETF concept and passive investing concept. And I'm recording through Zoom. There could be multiple, I'm new to this, and there could be multiple disturbances, and please pardon me for that. I hope it was useful, and subscribe if you like more such videos from me. Thank you.